Welcome to Crypto Gecko. So, before I already explained the four stages, which are trend analysis, area analysis, pattern analysis, and lastly, trick analysis. Once all these are combined perfectly and the analysis is spot on, then you start thinking, where should I enter and where should I exit? Because exiting is just as crucial as entering. It is like when you've managed to get into a prestigious university after rigorous selection and interviews, and now, what's important? You start thinking about how to exit. How do you complete your final project? Because many end up in a university of their choice but then struggle because they can't complete their final project. So, bear in exit is just like perfect entry. Exit is as important as entry. So, let me explain what entry is. Entry is knowing at which point or area you enter a trade, whether it is a buy position, a sell, or a short. That's the entry. Now, what about the exit? There are two aspects to it. First, when you are doing well, you exit to secure the profit you've gained from the trade. But when things go wrong and your analysis doesn't pan out, you also need to have a clear exit strategy because if your analysis fails, you inevitably have to cut your losses because not all your ideas will work out. Even with the most sophisticated computers and algorithms detecting market movements with size and liquidity at the smart money level, accuracy is only about 40%. So, when you're hitting 50% or even 70 to 80%, what does that mean? It means that you've outsmarted the robot. The details matter, like where you enter and where you exit. Entering and exiting through support and resistance level is perhaps the most common and clear method. It is as simple as drawing horizontal lines. You enter here, you exit here. When you sell short, you enter at the top, but you are betting on the price going down. Then, if it hits the floor, you exit. Entry is at the bottom, exit is at the top, and vice versa. If you are selling short, your top loss is about the swing high. When the first impulse is bearish, it retraces upward, and that's when you sell on weakness. So, your stop loss is above the swing high, and your target could be psychological levels, Fibonacci levels, or pivot targets. Now, entry and exit is important because they determine your risk-reward ratio. It is a ratio, either in decimal or percentage, that shows how much you are willing to lose compared to what you stand to gain if your analysis is correct. And can it be adjusted? Yes, you can adjust it according to the chart setups you find in the market. Why is this important? Because nobody in the world always gets it right in the market. Nobody. No matter how skilled they are. So that is where risk management comes in. Let's say you have 5 trades, and on average, you are right only twice, but you can still make a profit. That's the beauty of trading. Let's say you risk 1% per trade and you have $100 million. How much is your stop loss then? It is $1 million. So you have 3 trades where you lose $1 million each, and 2 where you make $3 million each. So negative $1 million plus $6 million equals what? You are still up by $2 million. That's trading for you. Different from gambling, like binary options where you either win or lose. So, in conclusion, Entry and exit are crucial to determine your risk reward ratio. And why is that important? Because if you don't want to take risk, you have to be prepared to lose. If you don't want to lose, you have to be prepared to take risk. There's no free lunch here. We don't rely on good feelings. We rely on data, analysis, and high probabilities. That's what helps us walk out of here with our accounts intact. So, I hope you understand now. With the scenarios, there are so many options. You have to consider your income, your time, and the risk you're willing to take.